This show is intended for informational and comic purposes only. We'll explore the wild world of real estate, investing, finance, and well, life. Did I mention I like sports also? The opinions here don't necessarily reflect the beliefs of my peers, co-realtors, family, friends, or even my brokerage. Nope, some of this is just shit I heard. Oh, and a heads up, there might be some cuss words and maybe even a few views you don't agree with, but hey, that's just the real world, so buckle up and enjoy the ride. They already called the cops on me? Dang, I just started. Wow. Hey guys, welcome to Wampler's podcast. First, I'd like to thank you for following me. Please like, share, do all the things. That's how I get better. This is out of my comfort zone. So you're going to watch a lot of errors here. I've even made it extra complicated by trying to control all the music, the cameras, the sound, the microphones, all that. So I'm going to do my best, but we'll get through it and we'll continue to grow. Let me get out. I got some notes here. Sorry, just quick notes so I can keep it. Let me get the other disclaimer out of the way, this other crap. I am just a licensed real estate agent. I am not an appraiser. I'm not an inspector. I'm not a builder. I'm not a surveyor. I'm not a lawyer. Hell, I'm not me, I guess. All right, so there you go. There's that. All right, so let's just get to a brief thing, what I'm trying to do with this podcast. First and foremost, just trying to make it a little bit humorous, give you some information, maybe bring in some live testimonials from my old clients, maybe even also talk to some builders, some developers, some movers, basically anything that I can kind of help you guys out with your buying or selling process. Also, I'm going to kind of go over my finances. That's kind of my background. I've got a degree in finance and supply chain management with a minor in economics. Not that that means anything in the real estate world, but I personally believe it helps me at least kind of identify and research a little bit more. Now, with that being said, let's go ahead and see what we got going on. First, a little bit about myself. My name's David Wampler. I'm a real estate agent here in the Middle Tennessee area. The market has been slow, obviously, over this last year, but I continue to grow, thankfully. And now, actually, what you're going to see is you're actually going to see me and starting to invest a little bit more in my marketing. I started out my career very, very red light, green light. Didn't need to spend the money where I didn't need to at the point of time. I didn't really see the point in marketing during those first couple years while I grew, learned the ins and outs of the real estate market. But also I knew I could sell myself just basically sitting in front of somebody and talking to them. But now, obviously, as the market slowed, I continue to grow. I see a very, very good opportunity, and most of my agents that have been around me have also realized that I keep saying, hey, 2025, 2026 is the years. So, myself personally, you've seen me double down on kind of investing on this little stuff here. Also doubled down on more marketing around the White House area. So you'll see me on these all the little basketball and baseball and football flyers. I'll be on some fences now. I've got all kinds of new marketing coming out. It's in my eyes a good time to invest as a real estate agent to kind of really capture this 2025, 2026 year. And yes, I am talking in 2-year increments because yes, real estate is a long-term game. If you think it's a short-term game, I'm not exactly sure you're really seeing the bigger picture. And that's why I hope these podcasts will help you or anybody else. But yeah, let's get back to these notes here, as I've lost my train of thought already. What we're going to go over here, we're going to go over the most recent Fed meeting. That's one of the big changes that happened this weekend. They dropped it a quarter point. Should be bringing it down to, what my notes say, 4.75 on the Fed rate. So we'll kind of go through that. I've got some explaining to do for some people on kind of what the Fed rate is versus your own mortgage rate. Also like to do a quick comparison of my data that I pulled up between just correlating federal interest rates and house prices. Also too, just kind of really briefly touching on the existing home sales that has been lagging to say the least. So with that being said, let's get this kicked off, and here we go. All right, so here we go. Now we're going to jump in to see what this Fed has to say. And once again, bear with me, guys. I'm going to go into a kind of a review session here. So let's zoom in, and I'm going to kind of probably take my eyes off of the camera here and kind of watch this here with you. So let's see what we got going on here. Here he comes. Hey, here we go. Here we go. He's coming anytime. Yeah, and like I said, guys, I've definitely done the PCI report. This is the PCI report also, so I know what he's talking about.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%.
So, even after this change, his projections is that the interest rate will not hit his goal until the end of 2025. 2.1%. That's what you just said.
Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight.
Okay, so right there, essentially he just said that he's on track to hit your 2% goal. We're basically at full employment. We don't really see any fears of an additional unemployment coming. So why are we dropping 5%? I know what you're thinking, David. Well, this is going to help out mortgages. Well, for one, and he's going to explain this a little later, is that they work in a lag. Okay, they work in a lag on that. That always going to come later. The first blip of money from this Fed are going to get probably ate up in the PCI if we're still fighting inflation. So yes, it will continue to lag on the housing market. Do I see it doing an instant boom? Not necessarily in the real estate market, but I do see it turning in the right direction for 2025, 2026. Let me go ahead and just jump ahead here, guys. Let me look at my notes here. Basically, let's go over here to Mrs. Kent with CBS. Okay, finally, Miss Kent. Yep, CBS finally asked one pointed question, and it actually is a very good one. Oh yeah, let me show you this here though. Oh, one more second. Let me show you this right here. This is where he shows kind of the projected interest rates going next year.
We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal.
All right, so let's stop it right here. All right, so what we got going on, guys, as you can see, essentially what this is, now all these little dots there are basically the individual Fed chairman kind of giving their projection of where they're going to see it. So essentially take this with a grain of salt, like you said, but this does kind of give us a decent idea of kind of what they are thinking based upon their projections. So what we've got going on here is they've actually got an average projection rate at the end of 2020 this year at 4.4%, or well, they really don't do in 0.4%, so we'll just say like 4.25% on the Fed rate. So what I would suggest is that what this is kind of indicating to us is we're probably going to get at least a 50 basis point drop, whether it's in one lump sum or one lump sum like they did this year. Once again, I don't really see that happening since a 50 point drop is only been done 3 times in the last 25 years. But you know, whatever. What do I know? Like I said, you read my disclaimer. I don't know anything. Um, but I do kind of like that, that is a decent projection. So that kind of matches up with, my game plan that I talked about earlier is the 2025-2026 season. Yes, we're gearing up. This is why I'm putting the money where I am. So I definitely like that. But let's get to Mrs. Kent. Seriously, she finally asked a pointed question. We got to get to it. I liked her question there. I think it's around 840. 840. Let's see here.
It's back then. How high is it? I just don't think we know. It's, again, we only know it by its works.
Thank you, Chair Powell. I'm Jolene Kent with CBS News. My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing.
First off, CBS for actually asking a pointed question. There you go. Absolutely love it. You finally asked a pointed question. But it is interesting, his answer. Everything's fine. So, again, why do we need the cut at this point? Eggs and milk are still high, guys. We are still talking about inflation.
Growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not doing, we're not saying mission accomplished or anything like that.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is
Cat right here is hilarious.
thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels, but they're not rolling over. The leases that are rolling over
astronomical levels,
coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this, but the direction of travel is clear, and as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now.
So, what I find interesting about that statement right there is he says something about we now know. Okay. Well, do we now know that, are you just now understanding that the housing market is dominated by the housing supply? Like, I don't understand that. Like, everybody's known that. So, what?
Several years rather than just one or two cycles of annual lease renewals. So I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So
All right, so whatever. Let me fast forward a little bit. with another one of Kat's questions because it is very, very good. But this here is basically where I like you'll see. Kat asked the question to him. Is it your fault or is it the government's fault? And of course, the feds do what? Kick the buck on down again.
We'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
The housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to find, to zone lots that are in places where people want to live. It's all of the aspects of housing are more difficult. And, where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria.
Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households?
Well, what I can say to the public is that we had a burst of inflation. Many other countries around the world had a similar burst of inflation, and when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. We just keep it low, keep it stable. We're restoring that. So what we're going through now really...
All right. So anyways, so there you have it. The Fed itself. That's kind of how I watch the Fed. Every time they come out. Also, know when the PCI reports are coming out. I'm big on my data. That's all I can say is I like the data. But so let me show you a little bit, kind of a history of kind of the federal interest rates on the adjustments up or down, and the price of the house and how it affects the price of the house. First thing, what you're probably going to see is interest rates are completely high. and then what you'll see is it drop over the period of time. What I don't like, one of my biggest pet peeves right now, and once again, I leave this all to the lenders to do their sale or whatever, but guys, I cannot sell you on historically low rates, okay? Or man, this is the great rate. Rates is just another variable in your housing equation to me. Because I guarantee you right now, what you're going to see is some of those astronomical prices, right? So let's see here. If I was to sell my house today, say for $400,000, right? $400,000, and boy, I've got a historically low rate on it because I'm actually going to do an owner financing also, and it's a historical low rate of, I don't know, let's say 3.5%. Oh my gosh, it's a historical low rate. Well, it's not the lowest rates we saw, number one. Number two, if my neighbor puts the exact same house up for sale, and he's going to do owner finance, because plain and simple, it's hard for buyers to get financed right now. He's going to put his house out there, same exact house, out there for $160,000 and 12% interest. It's the exact same house. It's valued at $500,000. Do you really think the interest rate is going to stop me from telling my buyer that that's the buy? Hell no. It's called the cost. Cost basis is where it's at, guys. That's where I see it. So yeah, sorry about the little rant about historically low rates and all that other shit. That just drives me nuts. Maybe I'll just call that one of my what grinds my gears in real estate. And that's probably it right there. That's one of them. I've got many. But let's continue. Let's hop over here. Let me show you why all that little jargon meant basically nothing. Let's transition over here to this. There we go. Look at this right here. Yeah, blue line. Blue line, you got the Fed rates. Red lines, you got the median price per house. Yes, it drops during recessions. Yes, we've had our wiggle. I think we're just finding our bottom here. It looks like the very tail. Looks like this interest rate's coming down, but as you can see, pretty much every time those interest rates have came down, it's definitely started to rise. You might get a small little blip right as they start cutting the rates. But once again, that's because everything's in lag. These guys are probably already needing to sell. Hell, it takes 45 days to sell your house sometimes. I mean, yeah, we can sell it quickly. But realistically, it's about 45 days to sell. So there you go. You could see another interest rate or price drop or whatever. It happens. Next, I'd like to talk about the existing home sales. Just kind of show you guys where we're at for the sellers out there. Make the deal, guys. For the buyers out there, put it on paper. Okay, just put it on paper. Let us just make the offer, guys. That's all you got to do. Just make the offer. Negotiations is king. Please share, like, and subscribe to the channel, and also sign up to my webpage there. Hey guys, so there you have it. There's Wampler's first podcast. Like to leave you today with a couple best. Yeah, I'm thinking I'm going to do best and the worst of the weekend. Even though it's not the weekend, but I'm going to go actually have a best and the best. So two best for me. My daughter made a traveling volleyball team. Spectacular. Awesome. Congratulations. And also too, a big shout out to my son Colin. He won the president of the 6th grade. I don't know exactly what that entails. Neither does he, but he won it, and we appreciate you guys and all that support. We'll continue to teach our kids good manners and help your kids as much as possible as well. With that being said, I do need some encouragement, guys. Like, share, follow. If you guys are thinking about real estate or have anything going on in the real estate, please, I would be honored to interview for your next real estate transaction. I believe if you let me in the door, you will be extremely happy.